Hey there, everyone. Dave Keller from Market Misbehavior. Thanks for joining me here today as we unveil our top 10 charts to watch for February 2025. We've done this video series a number of times over the years and have really gotten some great feedback. Just a good opportunity to highlight individual stocks and ETFs, individual charts with some compelling technical configurations we think you should be following. And I think you'll find with this group of 10 stocks that we highlight and ETFs that we highlight today, it's a good mix. Things in established uptrends that I think deserve most likely to be followed until proven otherwise. Stocks and ETFs sort of in a consolidation phase with an unclear direction, but one that I think could resolve certainly in the month of February. Others that are in breakdown mode, breaking down through key support. We'll talk about some of the technical reasons as to why those pictures remain fairly dark. Across those 10 charts, I hope it gives you some ideas to dig into a little bit further, some charts to follow through the month of February. Just gives you some things to think about. Before we get to these 10 charts and their technical implications, here's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions. And when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koyfin. Koyfin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koyfin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koyfin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. All right, so in maybe an order of sorts, but no, not in a rank order of any sorts. This isn't a top 10 list where I'm counting from 10 down to the big number one answer. This is a mix of things altogether. And before you think, all right, Dave is suggesting that you buy all of these things, I most certainly am not. Standard disclaimer, this is for educational purposes only. I simply want to use these as educational tools to help you understand the use of technical analysis in these different scenarios. Some of the charts that I think are very important to follow. And I'll be very clear with each of these charts what sort of particular levels and patterns and signals I think are going to be most important to watch in the month of February 2025 and why. And we'll start with one that we've talked about quite a lot on our market recap show called Chart This with Dave Keller, which coincidentally airs every weekday after the close at 5 p.m. Eastern on our YouTube channel. We've talked about the Semiconductor ETF, the SMH, on the show pretty much every day for the last couple weeks, because I would argue it is just one of the best representations of the current situation in the financial markets, right? The S&P and the NASDAQ, right? The S&P 500, the NASDAQ 100 are major U.S. benchmarks, are not going down, right, by any stretch. I mean, in the short term, you're seeing some noise, but overall, the medium term and long-term trends, and certainly the long-term trend remains quite positive. In the short term, though, you're seeing more of a sideways consolidation phase. And I think this chart of the SMH really tells the story of leading growth names like NVIDIA and AMD and other semiconductors that have struggled as of late. Now, all of these charts of pretty much any semiconductor are going to have what we call the DeepSeek gap. This is the gap lower a week and a half ago on Monday, a few weeks past, where we had the news over the weekend out of China of a new AI product called DeepSeek AI, and again, allegedly designed with minimal cost, or certainly a lot less than we thought would needed to be spent on growing generative AI capabilities. And stocks like NVIDIA and others, as weighted in the S&P, the semiconductor ETF, the SMH, got gapped lower aggressively early that Monday morning. And you can see on the SMH that gap from Friday's close to Monday's open, which is actually down here. And then you can see what's happened from then is the SMH actually found support. And then I think this is why the chart of the SMH is so meaningful. Over just the last couple weeks here, right, from early January to early February, we've kind of had it all. We've had a false breakout. We've had the SMH breaking to a new 3-month high, which is something I scan for all the time. Stocks making new 3-month highs or ETFs making new 3-month highs, which often indicates an influx of new something, new buying power or new catalyst for growth. I look for stocks and ETFs making new 3-month lows for the opposite reason, looking for things starting to break down below established support. So this popped up on my new 3-month highs list. And then soon after, I'm talking 24 to 48 hours after, we're getting a bearish engulfing pattern into the weekend and then the big gap lower, taking the SMH below its 200-day moving average. But what happened, though, was it didn't sell off much beyond that point. I think what was so interesting here in late January is you had a bunch of stocks gap lower because of the new DeepSeek AI news, instead of there just being a bunch of distribution after that. I remember on that Monday, it felt like that could just be the beginning of this waterfall decline for some of these previous leading names. It didn't happen, right? It didn't actually play out that way. And I think the fact that those stocks and the SMH as a whole has not gone much lower than that gap day is meaningful. I think that's a data point on its own. As a matter of fact, the SMH didn't even break to a new 3-month low, right? On a closing basis, it actually held the November and December low. So January all of a sudden just becomes, even though it was a gap, it becomes a retest of those support levels. Support held, and all of a sudden, now in early February, the SMH is bouncing back up there. NVIDIA is actually still within the range of that gap day, but kind of trading toward the upper end of the range. So I think charts like NVIDIA and AMD and certainly the SMH are important to watch. And I think the SMH would be the one I would start with because it's still an open question. I think there are times when a chart is clearly bullish, when we're making higher highs and higher lows on stronger momentum and stronger relative strength. There are clear negative periods excuse me, where the stock is making lower lows and lower highs on weaker momentum and weaker relative strength. Then there's situations like we find ourselves in over the last 3 months for semiconductors, which is the price is going sideways. We have a fairly consistent resistance and support levels, a clear range. The moving averages are flat. They're not really sloping upwards or downwards. The momentum is pretty neutral, with the RSI literally finishing, as we're recording this on February 6th, almost dead even at 50. So, this is a stock and this is an ETF in a consolidation phase. It's in wait-and-see mode. Jesse Livermore famously said there's time to go long, time to go short, and time to go fishing. I think if he were alive in 2025 and saw the chart of semiconductors, he would agree this is one of those charts to go fishing with. And you wait, right? You wait to see which way we break. At some point, the SMH breaks above 260 or breaks below 235, and that's the signal I will be looking for in the month of February. So first chart would be semiconductors, the SMH. Chart number 2, and I tried not to pick too many stocks just in these brilliant uptrends, just long-term consistent uptrends. And Palantir, again, didn't even make the cut. I've got too many other charts in other sectors that I think are good enough, and I'd already had enough technology to work with. But for every Costco, there are others like Palantir and Visa, MasterCard, one of which I grabbed a little later in the presentation, and many others in these nice, consistent uptrends. And even within consumer staples like Walmart, some of the other big box retailers actually looking quite strong as well. The reason why I think this is an important chart to watch, in February of 2025 is because it has had such a consistent uptrend. And going into, after a strong finish to 2023, I remember going into 2024, the question was, will that initial uptrend phase persist? And the answer was it absolutely did. We had pullbacks in March and April. We had a pullback in July, brief of stall there in September and October, but it kept making new highs soon after. We undercut the 50-day moving average a couple times, but not by much and not for very long. And I think what's important about the chart of Costco is when we did break below the 50-day, we really didn't undercut previous support levels by that much. And you could often look back and find a recent swing low that showed why the undercut of the 50-day, which not ideal,
didn't really take us below the previous swing lows. And we've seen that even most recently going into year end when we held that mid-November low. From there, we've made a new high yet again. So the chart of Costco, which actually in these previous charts to watch monthly videos that I've done in previous years, Costco has been a frequent appearance, has made a frequent appearance on these top 10 lists for this reason. From a technical perspective, it's just a nice, consistent compounder. It continues to make higher highs and higher lows. Currently, as we go into the end of the first trading week of February, you can see new all-time highs with Costco trading above 1,000. And I think that's why it's important to watch here in the month of February. We overshot the December previous all-time high at 1,000, and when we ended the year of last year trading lower, that all of a sudden felt like that big round number of 1,000 was going to serve as pretty key resistance. It did not here in the new year and in the new month of February. We've actually broken above 1,000 for the first time. So my question in the month of February, does that 1,000 level hold? Anytime we have a pivot point, a level that was resistance that is now broken, I immediately think of that as an initial stop. If I do take a position aggressively on a day like today, I immediately think of that 1,000 level, that previous resistance, which could become support as a line in the sand. That's where I'd set an alert and see if a chart like Costco can continue to make gains above and beyond that 1,000 threshold. That's chart number 2. Chart number 3 is Alphabet, right? And I think I hesitate. I feel like all the Magnificent 7 stocks could have easily been 7 of the 10 charts I would watch. And I can't tell you, any video that I would cut about charts to watch where I would not stress that I think those are the most important stocks of any to keep an eye on because there's such big weights in our growth-oriented benchmarks. So certainly we want to reinforce the importance of those names. But I picked one, Alphabet, because I think it's an important technical juncture. Alphabet reported earnings earlier this week. I mean, between last week and this week, you've had a bunch of the Magnificent 7 names reporting. Alphabet, one of the more disappointing earnings results. We can see that the company reported on Tuesday. Wednesday, we had a gap lower, which on the surface is not great, right? I mean, obviously, ideal situation is the stock does quite well, like a Palantir, like a Meta, strong earnings, stock makes new highs, and we just kind of continue and wait for the next quarter and ride the price up to the for the next couple of months, or at least that's the ideal. With Alphabet, we gapped lower, which is an ideal, but it didn't break down by much. And I think the bull case for the S&P and the NASDAQ beyond what we've seen so far into early February would have to include stocks like Alphabet regaining their mojo, regaining the uptrend phase. If they miss earnings, it can't be much of a technical hit because we want to make higher lows and continue that upward trajectory. Even with the earnings miss, even with the gap lower from Tuesday into Wednesday, stocks still holding an ascending 50-day moving average. Stocks still well above an upward sloping 200-day moving average, and that 200-day has held a number of times over the last 18 months. So I think the reason why this chart of Alphabet is important to watch is because the way forward is a little bit unclear. We're making new all-time highs. That's bullish, but the new highs recently have been coming on weaker momentum. That's a bearish momentum divergence. The stock gapped lower on earnings, which is negative, but it didn't break support and didn't break the 50-day moving average. So it's kind of mixed results right now, kind of mixed signals. And I think which way an Alphabet resolves could tell us a lot about the investability of the broader equity universe, about the potential for the S&P and the NASDAQ to continue their strength and push the S&P above 6,100. I don't see that how that happens in any meaningful way unless the Alphabets of the world continue their uptrend phase. So I think it's an important chart to watch right about now. Chart number 4, EPAM Systems. This might be the first of the 4 charts that you may be less familiar with. This is a mid-cap name, also in the software space. Well, you have a lot of charts like Meta and others that are at or near new all-time highs, Costco and others. You have a lot of stocks that are in clear downtrends that are in major pullback mode. We have a lot less stocks that have been struggling but are just starting to break out of an initial base. And I think that's where EPAM actually is happening right now in early February of 2024. We'll look back to the beginning of 2024. You can see the rally of higher highs on weaker momentum. Some bearish divergences ended up leading into the eventual top in March of last year. We then sold off aggressively in that big gap lower on earnings in May of 2024 really hurt, with the stock getting cut from 250 to below 200 overnight. From there, we drifted a little bit lower to make an eventual low around 170 and then started to trade back higher. Using that March 24 high and the June 24 low as a framework, applying the Fibonacci retracements, we can see the 38.2% level. I meant to draw this line there. Excuse me, I'm sorry I did not, but if you look, that 38.2% level lines up really well with the swing low in November. Also, this follow-up low in January, finding support right around that 38.2% level. We then eventually bounced above there. The 61.8% level is just above 261, and that is where we broke above today here on February 6th. So I would say from a technical perspective, the fact that we've broken through the first Fibonacci resistance, we've now broken through the second one, and given the impression that there may be further upside, I think that's a pretty strong resolution and a breakout to what could be a retest of the March 2024 high. I think the reason why this is an important one to watch is because it's had all the signs of a rotation from a distribution phase to more of an accumulation phase. The gap above the 200-day moving average, the pullbacks to that Fibonacci support, and then the final break above Fibonacci resistance, what appears to be a breakout this week. It could be an important one with a lot of stocks that are already very extended. EPAM in the software group within the technology sector could be one that's a little earlier on in its advance. All right, we're almost halfway through. Here's Marriott in the travel and tourism sort of theme. Obviously, in the hotels group within consumer discretionary, it's kind of a Costco-like chart. And again, I tried not to pick too many of these because there are a number of these that have had really strong trends. And overall, I would say still in a very much in a position of strength. What's interesting about Marriott, Hilton, and some of these other hotels is that they all pulled back in December. They all made a swing low in early January and now are rotating back higher. I like the fact that while other stocks are have already had a really good run and feel very overvalued relative to their trends, Marriott is actually just beginning to break out above that December peak. So I like the fact that it feels a little earlier on in the breakout. I'm especially impressed with the relative performance over the last 6 months. Charts like Marriott are most impressive by the consistent outperformance of the S&P 500. If you want to outperform the S&P, you have to own things that are outperforming the S&P. For now, Marriott is certainly one of those. So I think Marriott is kind of a placeholder representing some of those other travel and tourism names, thinking of Hilton as another one that I almost selected instead, and thinking about some of those hotels that have had a good run and see if they're able to hold them. All right, we are now over halfway through. Let's get to chart number 6, which is Visa, ticker V. Visa, of course, I think the last one that's just been in a nice consistent uptrend again. It's so tempting to pick so many of these, but what I like about the chart of Visa that I think differentiates it from other one is this pattern back here. And if you followed me in my work, you may know exactly what that pattern is called. It is called a cup and handle pattern. Cup and handle pattern was popularized by Bill O'Neill, founder of Investors Business Daily and author of one of my favorite books on investing, How to Make Money in Stocks. And by the way, if you don't have that book, you can go to my recommended reading list at marketmisbehavior.com/reading list, or just go to the main site, click on reading list at the top. You'll see that William O'Neill book along with a bunch of other ones, Intro to Investing, to Technical Analysis, Behavioral Finance, Personal Development, Mindfulness, so many other really good, I hope, transformative topics for you. The cup and handle pattern, as popularized by Bill O'Neill, is a run higher, and then you have this rounded sort of consolidation pattern, then a shallower pullback, a consistent rim of the cup. So you have the cup, you have the handle. The break above the rim is what's so important. So that breakout above 290, which ended up coming in early November of last year, was pretty important. From there, it's been off to the races. We had a pullback to the 50-day at the beginning of this year, and now rotating back to the upside. It's recently extremely overbought, which means at some point you probably get a bit of a pullback. You'll notice the last couple times we were in that overbought range in September. In November, we ended up having pullbacks to an ascending 50-day moving average, which ended up providing a really good sort of additional entry point. So I would say with something like Visa, it's important to watch to see if we get that higher low, that pullback to an actionable entry point, maybe at an ascending 50-day moving average, giving you the opportunity to buy in on the weakness, the short-term weakness within a long-term uptrend. But Visa, obviously a pretty strong chart so far this year. Chart number 7, Wells Fargo, same sector, very different company. Visa, obviously, payment processing, credit cards. Wells Fargo, more traditional banking. And if you look at the chart of WFC, again, while a lot of stocks feel a little overextended, like a Palantir, which has already had such a run, in early 2025, I would say WFC is still maybe a little earlier on in there. It's just clearing the November peak from around Thanksgiving, right around $77, $78. We broke above there actually in January, pulled back briefly to that level, and now resolving to the upside. And that's why I think it's kind of an interesting point here. We had pulled back to the 50-day, we had pushed higher, but it's all about can we clear those previous all-time highs, and we're just starting to do that. If you look back in history, a lot of times when I see a chart like this, people will say, is that too late? Like, did I miss it? And if you look back just on this chart, you can see times where we tested resistance and broke above it, and that often was the beginning of a great move, right? Here, example, in December, January, February of 24, we broke above that level, and that ended up being percentage point gains above that breakout point before we made to the next high. So I would say the fact that we're just starting to break out on impressive relative strength, on stronger volume or stronger momentum, that is, I think is a strong argument for a chart like WFC. I would also say a lot of the financial stocks like JP Morgan, maybe some of the regional banks have shown some renewed strength here over the last 6 months. The yield curve having a more normal shape, I think, is a big part of that story. But from a technical perspective, I especially like the relative strength, which speaks to how this sector, these stocks are doing better than the benchmarks. And that is how you can outperform, by finding those names with improving relative strength. All right, we're back in the technology sector for stock number 8, Salesforce.com, ticker CRM. This one less of a bullish tell, I would say here. This one, I think, is a little more of a question mark. And you will find that, right? I mean, generally speaking, I find in more value-oriented sectors like consumer staples, like financials, maybe even healthcare, you're finding some names with improving technical configurations, a little earlier on, a little emerging strength. Whereas within technology and other growth sectors, you've had things in some cases that have been running for quite some time, and like in Alphabet, all of a sudden starting to be a bit of a question mark on those uptrends. And the question is whether we're able to have a sustained uptrend beyond what we've seen so far. I think with CRM, that early December peak around 370, that gap was important. From a technical perspective, this is actually what we would call an exhaustion gap. That's when you have a big run higher, and then after that established uptrend, you have one big gap to the upside. And after that final gap, we start to sell off. The exhaustion gap basically means that is the last final hurrah. That's the 9th inning. We're done, and all of a sudden there's no one left to buy it. The anecdotal last buyer has bought shares, and no one's left to spur demand and push prices even higher. We can see additional signs of a bull trend in exhaustion by the fact that in late January, we rallied up to that gap level, right, for around 370. You can see here in late January, we traded right up to 365 or so, retested those highs, that gap range, and now trading back lower. So I think CRM is an important chart to watch in February to see if it's able to regain its momentum and break to new highs. I'm skeptical by the fact that we had bearish divergences going into the December peak. We had the exhaustion gap, which now has been retested and confirmed. I think for now, this is a chart more guilty until proven innocent than the opposite. And I think for now, waiting for an upside breakout that validates a new uptrend phase, I think would be important. I would be watching this one for a breakdown watch, keeping an eye on that January low around 315. We're almost done here. Chart number 9, probably the most unique out of the 10 charts I'm going to show you because it's a chart in a long-term downtrend. I am finding in the healthcare sector, while some of those stocks are still struggling quite a bit, and the long-term chart of Humana has been very challenging from a technical perspective. And what makes it that way? Well, it's below 2 downward sloping moving averages for much of this period. We've had a series of attempts to regain the 200-day moving average here in July, here in September of last year. those attempts failed, and we failed to gain any momentum above the 200-day, and then we subsequently made new lows. We have a downside exhaustion gap here going into early October of last year, had a false break and tried to regain some momentum, ended up retesting those lows in mid-December, but now we're actually testing the upper end of the range from the fourth quarter. So now all of a sudden you have the stock pulling back a bit below the 300 level after a retest of the November peak. We're just below the 200-day moving average around 315. I don't know whether this stock is going to eventually break above the 200-day, but after you have had a stock like this in an established downtrend with a series of failed attempts to break the 200-day, I'm happy waiting patiently for that breakout to finally arrive. And I would say if and when a Humana can get above its 200-day moving average and finally change the trajectory, break to a new swing high, break above that moving average, I think that could be a really compelling chart with some long-term potential. But we have to wait for that breakout first. So I think chart number 9 here, Humana, represents a series of healthcare names. While the long-term trends are still down, while I don't see enough technical evidence yet to justify a long position for myself, I would tell you these are the charts I'm looking for actionable signals in the month of February. The last one, and this is a bit of a different one, is the real estate sector, XLRE. With my market misbehavior premium members, I've often talked about what I call my market top checklist. 7 items that I look for in a bullish market environment as signs of deterioration, signs that maybe the bull market is starting to be near its end. For the record, I've started to see a couple of those check marks appear as I review the evidence week in, week out. And I would say one we have not seen yet is an improvement in the relative performance of defensive sectors. Something happens at the end of a bull market phase, usually, where institutions start to get nervous, and institutional investors, which have to be fully invested, right? So a big money manager most likely has limited cash that they can have in their portfolio. They are paid to own stocks, and so they have to own a portfolio of equities. So what happens if you have to own stocks and you think the market's going down? Well, you can't sell the stocks and go to cash because that's not within your mandate. You have to be fully invested. So what you do is you go to low volatility areas of the market. You go to areas of the market that tend to have a higher dividend component, so a higher income. So you will get that dividend benefit if you hold the names through the period. And also because they're lower volatility. That means if the market goes down a ton, these sectors and these stocks will probably go down less because they're lower volatility, lower risk, lower movement. Lower volatility is not great in a bull market because you're probably going to gain less than the averages, but in a down market, they're great places to be because you'll lose less than the major averages. So it's a way to survive and outperform during periods of market instability. Real estate, utilities, consumer staples are kind of 3 classic defensive sectors. Healthcare to a lesser degree that I would think of for investors to make that sort of bet. So the relative performance of the real estate sector, which is the bottom panel on this chart, that blue line shows the relative performance of a real estate sector versus the S&P. The last 2 times you can see some rallies were in July, August, which was during a pullback period for the S&P 500. Also in the fourth quarter of 2023, we actually saw real estate do quite well. If and when real estate starts to improve on a relative basis, that could indicate that institutions are starting to get more defensive. That, for me, would certainly be one of the checks on my market top checklists. And while I've not seen signs of a big rotation into defensive sectors, if the Magnificent Seven stocks struggle as they have started to do around earnings and they start to lag, the question is, where do assets rotate? If they rotate out of the Mag 7 names, if it goes into defensive sectors like real estate, I personally would be very concerned about the uptrend beyond what we've seen so far. So there you go. Those are the top 10 charts I'll be watching for February 2025. Did I miss any? Which ones would you have put on your top 10 list? Make sure you drop a comment below and let me know which charts you would have included and why. By the way, if you want to learn more about some of the techniques that I was describing, things like exhaustion gaps and relative performance and sector rotation and Fibonacci retracements and anything and everything else that we've gone through from a technical perspective, if you want to learn more about those tools and techniques and how they can help you manage risk and identify opportunities for your portfolio, our Market Misbehavior Premium memberships may be a really good gift to yourself here around Valentine's Day in 2025. Go to marketmisbehavior.com/premium for more more information on our premium memberships, give you all the information about what's included. 3 main things I would highlight. Number 1, virtual courses on technical analysis, behavioral finance, and good investment routines. Members-only reports like our weekly flight plan and our monthly chart review, where we apply our proprietary market trend model to a bunch of different ETFs and focus on big picture themes and rotations. Finally, you'll have access to our members-only community. You will get access to me, any questions that you put in there. I'm in there every morning answering questions from some of my premium members. Some of my other premium members that have been with me for quite some time may weigh in and share some advice or insights of their own. All of that is included in our Market Misbehavior premium memberships. Go to marketmisbehavior.com/premium for more info, and make sure you use the code YouTube for 20% off your first 12 months on any plan. That's it for today. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts.